This is part 7 in the series titled The State of the United States Economy and Society. I'm Edward Dotson. Part 7 is titled The Ownership of Property. The ownership of a residential property was almost taken for granted by a majority of white Americans who reached adulthood in the 1950s. Their children who entered the workforce in the 1970s, and even their grandchildren who came of age in the 1990s. With each passing year, and despite a significant property market crash in 2008, property prices in 2025 are now out of reach of an increasing percentage of young people reaching adulthood. Many others whose incomes have not kept pace are having difficulty just keeping up with rising rental charges. What is not widely understood is that the crash of the nation's property markets in 2007 and 2008 has had long-lasting consequences, unevenly distributed across the United States. It will be useful to look at the history going back to the 1950s. Beginning in the 1950s, millions of young adults left the nation's cities to live in the new suburban communities characterized by affordable, single-family detached housing on a small parcel of land. Millions of veterans had access to mortgage loans because of the guarantee to banks by the Veterans Administration. Others who met the income eligibility criteria were also able to obtain financing because of guarantees by the Federal Housing Administration. From that time on, residential property markets have been a key driver of the U.S. economy. Consider the long list of participants in the housing sector, from landowners and building contractors to the retail sellers of everything required to make a house a home, to landscaping services and companies who service a home's key systems and equipment. The darker side of our financial system is evidenced by the millions of households who, since 2008, have lost the properties they lived in, sometimes after many years of occupancy. On the plus side, foreclosures during 2024 fell by 10% from 2023 to 322,103. Natural disasters drove mortgage delinquencies in November 2024 to their highest level in 3 years. Some 2 million mortgagors, that is borrowers, were 30 days or more delinquent on their mortgage payments. 3 hurricanes are cited as the cause of 61,000 delinquencies. Of the total delinquencies, 512,000 are seriously delinquent, meaning they are 90 days or more past due. Foreclosure proceedings was started in November on 21,000 properties. In response to the disastrous California fires, Fannie Mae and Freddie Mac announced on January 10 a mortgage assistance and relief plan that would grant to eligible property owners a 12-month forbearance without incurring late fees. Property owners must continue to pay their property taxes, however. For properties with the housing unit destroyed, the county will collect tax only on the land value. In the fourth quarter of 2024, the homeownership rate in the United States was 65.7%. There is a real question whether this level of ownership can be sustained as property, that is land values, continue to climb even as mortgage interest rate increases make it more difficult to more potential buyers to qualify for financing. We should not be surprised by the much lower rate of home ownership for property owners aged 35 and under. First-time buyers have had the challenge of accumulating savings toward a cash down payment and to cover closing costs while absorbing increasing rental charges. A November 2024 report issued by the National Association of Realtors indicates that the median age of first-time homebuyers rose to 38 from 35 in 2023. This chart shows the percentage of first-time buyers in each age group for 2024. Mid-2024 data from the Census and Atom Data Solutions was used to construct this graph. For those who have owned their residential property for any length of time, the combination of loan amortization and rising land prices generates enormous equity. As of August 2024, the total value of all residential property in the United States was estimated to be $49.6 trillion. Analysts hold widely different opinions over whether these prices can be sustained if mortgage interest rates increase. For some time now, there has been a shortage of available properties in many markets. The pandemic, inflation, current owners aging in place, rising land costs to developers, and community resistance to higher density development have all contributed. Mortgage originations in 2024 were about evenly divided between purchase money and refinance transactions, with many property owners taking advantage of fallen interest rates to refinance. One of the serious challenges for communities looking to increase the supply of affordable housing is, of course, acquiring land at a price that allows affordable housing units to be constructed. The problem is not universal, however. Many cities have large quantities of land that can be offered to developers at below private market prices in return for a commitment to construct affordable housing. In 2014, the city of Chicago began selling city-owned lots for $1 to, quote, local property owners who committed to developing the lots with new housing units. As of October 2018, nearly 2,000 lots had been sold out of some 32,000 vacant lots. In 2022, the program was revised to price the remaining lots for at least 10% of market value. Cities often decide to raise cash by selling off prime publicly owned locations. A much better long-term option, I argue, is to offer the land under a leasehold arrangement that allows for increases in the ground rent payments as market circumstances warrant. This chart shows that despite seasonal volatility and the effects of other factors such as regional economic changes or increasing mortgage interest rates, a residential property has been a rather good investment, providing one is not forced to sell during the bottom of a cyclical downturn in the land market. Property assessments almost everywhere remain unchanged for many years, which also results in windfall gains for those owners whose properties have increased the most each year. This list of the markets with the higher percentage increases in property prices indicates that many people are deciding to relocate to places where housing remains affordable. Some are able to take their gains by selling in a high-cost market, purchase a property elsewhere, and still have a considerable net gain. The Pew Trust reported in November 2024 on the in and out migration of residents from states. In 2022, 19 states lost population. Just 8 states lost residents in 2023. The states with the fastest growing populations have been South Carolina, Florida, and Texas, followed by Idaho, North Carolina, and Delaware. 8 states continued to lose residents in 2023, topped by New York and followed by Louisiana, Hawaii, Illinois, West Virginia, California, Oregon, and Pennsylvania. Shifts in population affect property markets, of course, but this is only one of the factors involved. While labor, materials costs, and government fees can differ to some extent location to location, the fundamental reason for the huge difference in the asking price for a residential property is the cost of land. As this chart confirms, the cost of a building lot makes it difficult to construct housing affordable to low and moderate income households, certainly not single-family detached construction. This map provides a general look at regional differences. Land values in the major markets within these regions are certainly multiples of the median. Zillow identifies the Buffalo, New York MSA as the fastest growing property market in the country during 2025, with properties selling very quickly. Buffalo is followed by Indianapolis, Providence, Rhode Island, Hartford, Connecticut, Philadelphia, St. Louis, Missouri, Charlotte, North Carolina, Kansas City, Missouri, Richmond, Virginia, and Salt Lake City, Utah. The cost of a residential property is only one, but also a major factor for calculating the cost of living in a city or its extended metropolitan area. The percentage of properties that change ownership in a given year is small. When market prices have been increasing over time, sellers experience significant gains, which may or may not be utilized toward the next purchase. As already observed, renters have the least control over their housing costs and experience the most difficulty qualifying to purchase a property. Other factors include local taxes, utility costs, cost of childcare, insurance premiums, and the cost of food. With median property prices in California double that of many other parts of the country, there has been an exodus of people and businesses. Statistics provided by the California Department of Finance indicate that the net loss of residents from 2015 through 2023 was around 731,000. Robin Dillon Merrill, a professor in the McDonough School of Business at Georgetown University, recently offered her analysis of the wildfires that destroyed over 16,000 buildings and caused an estimated $50 billion in destroyed property. Here are a few of her observations and conclusions. Some people will have the flexibility to leave the California area. Others will rebuild. Those who rebuild will choose how much of the latest knowledge of fire protection to include in new construction. People's socioeconomic backgrounds will dictate the quality of reconstruction that can be afforded. Leaving the area may be easier for people in poverty with low incomes, since they are more likely to be renters than homeowners. She follows this with what is certainly the other major issue wherever these destructive disasters occur. The insurance industry in California has been problematic initially because of earthquakes and then because of wildfires. Most people expect premiums in areas of high risk for disasters will need to increase, but some of the increase may be offset by lower property values in high-risk areas. Higher insurance prices will be difficult for the lowest income homeowners, and thus some form of government aid may be needed. The city of Philadelphia has been experiencing a construction boom since before the COVID-19 pandemic. There have also been extensive renovations of historic buildings. Demand has been fueled by higher income millennials, by New Yorkers seeking to take advantage of Philadelphia's lower residential property costs, and by empty nesters leaving the suburbs. 20 projects were completed in 2024, and there are over 30 more underway. 43 out of 53 of these projects have residential components. Many small towns across the United States are losing population, particularly of younger adults. Some, such as Marquette, Kansas, will give new arrivals a building lot for free. What is happening in Detroit is a clear sign that the city is recovering from a long period of disinvestment. In November 2024, the median sale price of a property in the city of Detroit was $87,500. Still very affordable, but a 16.7% increase from the previous year. And just 1 month later, the median sale price reached $95,000. The mayor of Detroit reported in October 2024 that $1 billion had been invested in the construction of 4,600 affordable housing units between 2019 and 2024. As population growth and new household formation has increased the demand for land and housing in many suburban regions, older existing houses are often purchased by developers who tear them down and build much larger homes, or obtain approval to subdivide the lot to construct more than one home. From a public policy perspective, it is vital to consider the market for housing as separate and distinct from the market for the land on which the housing unit is constructed. The value of a house is its replacement cost, less what depreciation the house has experienced. The difference between this value and the total price for the property is the value of the location, a value determined by factors outside whatever improvement exists, a value largely determined by the quality of public goods and services brought to the location. The very same housing unit will, as we know, have a significantly different selling price depending on the neighborhood and the community. That completes my analysis of the current state of the nation's property markets. Next, we will examine the widening gaps in income and wealth.